Right now, there are families in America who will lose everything: their home, their savings, their children's future, not because of a disaster, not because of bad luck, but because someone made one single mistake. They waited too long to buy life insurance. In this video, we are going inside the world of life insurance, stripping away the jargon, the salesmanship, and the confusion to give you a clear, honest picture of what it is, what it costs, and how to buy it the right way. This is not a sales pitch. This is a guide. Chapter 1. What life insurance actually is. At its core, life insurance is a contract. You pay a company a monthly or annual amount called a premium. In exchange, if you die while the policy is active, the company pays a lump sum called the death benefit directly to whoever you choose. That person is your beneficiary. That is the entire concept. Everything else, every policy type, every rider, every sales technique is just a variation on that single simple deal. So why do so many people avoid it? According to LIMRA, nearly 40% of Americans have no life insurance at all. The reasons are usually the same. It feels morbid to think about death, the options seem confusing, and people assume it will be too expensive. But here is what is actually expensive: being the family that gets left behind without it. In 2023, the average American family needed $700,000 to maintain their standard of living if the primary earner died suddenly. The median life insurance payout, just $250,000. That gap is not a minor inconvenience gap, it is a financial catastrophe. Chapter 2. The 3 types of life insurance, and which one is actually right for you. Term life insurance is the most straightforward product in the insurance industry. You choose a coverage amount and a term length, typically 10, 20, or 30 years. During that term, you pay a fixed monthly premium. If you die within the term, your beneficiaries receive the death benefit. If you outlive the term, and statistically most people do, the policy expires and you receive nothing back. No cash value, no investment, just pure protection. And that is exactly why term life is so affordable. A healthy 35-year-old can get $1 million of coverage for as little as $30 a month. For most families, this is the right starting point. Whole life insurance is a different animal entirely. It covers you for your entire life, as long as you keep paying premiums. It also builds something called cash value over time, a savings component that grows slowly and can be borrowed against. The premiums are dramatically higher than term life. We are talking 5 to 15 times more expensive for the same death benefit. The industry markets whole life as a combination of protection and wealth building. The reality? For the vast majority of people, you are better off buying term insurance and investing the premium difference in a low-cost index fund. The math almost never favors whole life, unless you have specific estate planning needs or a very high net worth. Universal life insurance sits in between. It offers permanent coverage like whole life, but with more flexibility. Your premiums can adjust. Your death benefit can change over time. And yes, it also has a cash value component tied to either a fixed interest rate, the stock market in variable universal life, or a bond index in indexed universal life. The flexibility sounds attractive, but that flexibility also means complexity. Policies can lapse if you do not manage them actively. For most working families, the added complexity creates more risk than it eliminates. Know that these products exist, understand their structure, then decide with a fee-only financial advisor, not a commissioned salesperson. Chapter 3. How insurance companies actually price your life and what you can do about it. When you apply for life insurance, you go through a process called underwriting. The insurer is trying to answer one question: how likely is this person to die during the policy term? They look at your age, your gender, your health history, your family's health history, your weight, whether you smoke, your driving record, and sometimes even your occupation and hobbies. Based on this assessment, you are placed into a risk class. The best class, called Preferred Plus or Super Preferred depending on the company, gets you the lowest possible premium. A lower risk class means a higher price. Here's what matters. You can influence your risk class. Quitting smoking before you apply. Insurers typically require you to be smoke-free for 12 months to qualify as a non-smoker, can cut your premiums by up to 60%. Losing weight. Getting your blood pressure under control. These are not just good for your health, they are literally financial decisions. A 35-year-old male who qualifies for Preferred Plus versus Standard Plus on $1 million 20-year term policy might pay $12 a month versus $39 a month. Over 20 years, that difference is over $6,000. Chapter 4. How much life insurance do you actually need? The most common advice you will hear is the DIME formula: debt, income, mortgage, education. Add up your total debts. Add 10 times your annual income to replace your earning power. Add your remaining mortgage balance. Add the estimated cost of your children's college education. This gives you a baseline. However, there is a simpler mental model that works for most families. Multiply your annual income by 10 to 12. If you earn $70,000 per year, you likely need between $700,000 and $840,000 in coverage. If you have dependents, children, an aging parent, add more. If your spouse earns a comparable income, you may need slightly less. The goal is simple. If you disappear tomorrow, your family should be able to maintain their life. Chapter 5. The Smart Buyer's Blueprint: How to get the best policy at the best price. Rule 1. Buy term, not whole life, unless a specialist specifically advises otherwise for your tax situation. Rule 2. Shop across multiple carriers. Insurance rates are not standard. The same person with the same health profile can receive quotes that vary by 40 or 50% across different insurers. Use an independent broker, not a captive agent tied to one company. Rule 3. Apply when you are healthy. Every year you wait, premiums increase. Every new health issue, a diagnosis, a medication, a procedure, can bump you into a worse risk class or in extreme cases make you uninsurable altogether. There is no good time to buy life insurance. There is only now versus later, and later always costs more. Life insurance is not about death. It is about love. It is a financial declaration that the people who depend on you will be protected, no matter what happens. The tragedy is not dying young. The tragedy is dying without having put this in place. You now understand the product, the pricing, and the strategy. The only thing left is to act. If this helped you understand life insurance in a new way, smash that subscribe button. We break down complex financial topics every week in plain English, with no jargon and no agenda. Hit like if you found value here, and drop a comment below. What insurance topic do you want us to cover next? See you in the next one.